Welcome back to the Deep Dive.
Yeah, thanks for having me.
It is Friday, February 27th, 2026. And I got to say, if you've been trying to get a clear read on the commercial real estate market this week,
You're probably suffering from whiplash.
seriously, I mean, we're looking at a market that just seems to be operating with a severe case of split personality disorder right now.
That is probably the most accurate way to describe it. Usually when we look at market trends, the arrows generally all point in the same direction, you know? But this week,
Complete chaos.
right, we have absolute carnage in one sector and then just record-breaking confidence in another. And it's often happening within the exact same zip codes.
Yeah, it's a week of extreme contrasts. On one hand, you've got headlines totally dominated by luxury retail giants filing for bankruptcy, closing flagship stores left and right.
And then on the other hand, specifically right here in our backyard in Texas, we're seeing massive institutional capital pouring, nearly $500 million into grocery-anchored centers.
It's the definition of a bifurcated market. And for you listening, especially our Eureka Business Group audience, this is the critical signal, right? We aren't just reading headlines today.
No, we're cutting through the noise.
Exactly. We need to figure out what actually matters for a commercial real estate broker in Dallas-Fort Worth who specializes in retail. Because the question isn't just, is the market good or bad?
Right. It's which specific asset class are you holding?
Right. So that's our mission for this deep dive. We've organized the stack today into three main pillars. First, we're going to unpack this tale of two retails.
Yeah, why Saks Global is in bankruptcy court while Blackstone is writing massive checks for Texas strip centers.
Exactly. Second, we have to look at the engine under the hood. You know, retail follows rooftops.
And rooftops follow jobs.
Spot on. So we have some real significant news from Apple down in Houston and a massive, massive commitment from AT&T in Plano that fundamentally changes the demand curve for service retail in those corridors.
Absolutely. And finally, we just can't ignore the macro landscape.
The Supreme Court.
Yeah, they dropped a bombshell ruling on tariffs this week.
Yeah.
And whatever your politics are, we need to discuss what that legal chaos means strictly from a business perspective.
Yeah, what it means for construction costs, deal underwriting, the volatility developers are going to face for the rest of 2026. We are completely neutral on the policy itself, but the economic impact is huge.
There is a lot of ground to cover. Let's start with the money.
Yeah, let's jump right into the biggest signal of the week. If you are a retail broker in Texas, this specific transaction just validates everything you've been telling your clients. Blackstone is back.
They certainly are, and in a very big way.
Yeah.
The headline here is that Blackstone secured a $331 million loan to support the acquisition of a retail portfolio.
Valued at $441.5 million, right?
Exactly. But what's really fascinating is the composition of that portfolio. Because this isn't high glamour fashion districts in New York or LA.
No.
This is a 16-property portfolio entirely located in Texas.
Let's break down that geography real quick because it's heavily weighted toward our markets. We're talking 11 properties in the Houston area, 4 right here in DFW, and 1 down in San Antonio.
Right. But the key here isn't just where they are, it's what they are.
Grocery anchored?
Grocery-anchored centers. We're talking tenants like H-E-B and Kroger. And the portfolio is 96% occupied.
Wow, 96.
Yeah. That occupancy rate is the critical data point for you guys. It tells us that despite the noise in the wider economy, the fundamentals for daily needs retail are just incredibly tight right now.
It's a staggering number.
Yeah.
And it completely validates the strategy that Eureka Business Group has been focused on. I was reading the quotes. And Blackstone's managing director, Adam Leslie, he explicitly called grocery-anchored retail a high-conviction theme.
Which is strong language from them.
Right. When the world's largest alternative asset manager uses that kind of phrasing, they're signaling that the smart money is betting on essential goods.
They aren't betting on the discretionary consumer buying luxury handbags.
No, they're betting on the recurring revenue of people buying eggs and milk.
It's a defensive play that acts like an offensive play. And it's not just Blackstone doing this. When we look at the local level right here in DFW, the activity supports this thesis entirely.
Let's hear the local stuff.
Well, I was reviewing the development reports for Garland, and H-E-B is currently eyeing 2 new store projects there.
2 of them. That's significant expansion.
It's happening across the Metroplex. Up in McKinney, work is already underway on a 99,000 square foot Kroger marketplace.
99,000. That's a massive footprint for a grocer.
And down in Austin, Asana Partners just acquired the Arboretum.
Oh, right, the major open-air center.
Exactly. Capital is aggressively chasing these open-air accessible formats, and we shouldn't overlook Arlington either.
What's happening in Arlington?
Trademark is currently seeking incentives for a $100 million redevelopment of a retail center there. But they aren't just giving it a facelift, they're converting it into a mixed-use hub.
Which connects to that broader trend we keep seeing, where retail alone isn't really enough anymore. It has to be a destination.
A destination grounded in utility, yes.
Which perfectly brings us to the flip side of this coin. Because while the grocery anchors and the open-air centers are thriving, the enclosed malls and the luxury sector are having just a catastrophic week.
Yeah, this is where that bifurcation becomes undeniable.
It's a grim reality for that sector. On February 19th, Saks Global filed for bankruptcy.
Right, and just to remind everyone, this is the parent company of Saks Fifth Avenue, Neiman Marcus, and Bergdorf Goodman.
The absolute titans of the luxury department store model.
And the scale of this filing is massive. It impacts 125 stores.
Which translates to about 13 million square feet of retail space hitting the fan.
And the analysis on this is super concerning for anyone holding that kind of asset, because analysts are warning that backfilling these marquee locations is going to be incredibly difficult.
Yeah, we're talking about Fifth Avenue in New York or Beverly Hills.
Exactly. If a Neiman Marcus goes dark, you can't just subdivide that space for a dry cleaner and a dentist.
Right, the box is too big. The operational costs are way too high.
It highlights the existential struggle of the legacy enclosed mall model perfectly. And we also saw AMC Theaters announce they expect to close more theaters than they open.
Oh, wow. Yeah, the hits keep coming for those big mall footprints. And speaking of malls, we saw a very stark data point regarding the Palisade Center in New York this week.
Ah, yes. The 12th largest mall in the country.
It just sold for $175 million after a foreclosure.
Which sounds like a lot until you hear the context.
Right. For context, that exact same mall was appraised at $881 million back in 2016.
That is the math that keeps mall owners up at night, selling for a fraction of its previous value.
It's a bloodbath.
It's the reckoning we've been expecting. If you own an enclosed mall with struggling department store anchors, your valuations are evaporating.
But if you own a Texas strip center with an H-E-B,
you are seeing valuation growth.
It's incredible how distinct those two paths have become. But I want to pivot a bit to why Texas specifically is seeing all this investment. Because Blackstone isn't just throwing darts at a map.
No, they're following the demographic and economic growth. You can't have successful retail without population growth and disposable income.
Retail follows rooftops.
And this week provided some massive evidence that the Texas supercycle regarding jobs is still running incredibly hot.
Yeah, the big news for DFW specifically has to be AT&T. This is a huge commitment to the northern suburbs.
Massive for Plano. The City Council just approved incentives for AT&T to redevelop the former EDS campus. We are talking about a $1.35 billion investment.
$1.35 billion. That number is insane. That's the kind of money usually reserved for massive manufacturing plants or stadiums.
And it's not just a renovation. It's a commitment to a 2 million square foot campus. But the most important number for you as a retail broker is the people.
The 4,000 jobs.
Yes. They are committing to 4,000 jobs initially, with plans to grow that significantly over the next decade.
That is 4,000 people who need lunch every day, who need dry cleaning, who need to grab groceries on their way home.
It creates an immediate, dense radius of demand for any retail center in that Legacy Drive corridor.
Exactly. And it's important to note the type of jobs, too. These are high-paying corporate roles.
True, but the Texas story is also heavily leaning into industrial and high-tech manufacturing right now, which brings a totally different kind of stability, like the big headline out of Houston this week regarding Apple.
Right. Apple is doubling their footprint down there, correct?
Yeah, they're expanding their Houston manufacturing facility to 500,000 square feet. But the critical detail is what they're making. They are going to be producing the Mac Mini computers there.
Really?
It's the first time those have been made in the U.S.
That is a major win for onshoring. We always talk about it as this abstract concept, but here is a very tangible example.
It is, and it's part of a larger cluster. If you look at Sherman, just north of us, that $4 billion chip fab has finally started production.
Excellent.
And in the Fort Worth area, a magnet maker is building a $1.25 billion plant. A data center supplier is eyeing an $80 million plant there, too.
And didn't a pharma giant just select Denton?
Yep, for a $280 million factory. The industrial velocity is just relentless.
It really is.
And this industrial growth creates what we call sticky jobs. These aren't call center jobs that a company can just move overseas in a month.
Right, because of the physical infrastructure.
Exactly. These are capital-intensive manufacturing roles that drives long-term household formation. And frankly, that explains why Dallas and Austin are currently ranking #1 and #2 in the nation for multifamily deliveries.
And all those new apartments need places to shop.
They do.
But I'm noticing a real shift in how these developments are actually being built. It's not just let's build an apartment complex and put a strip mall next to it anymore. We're seeing these massive districts.
Yes, the district trend is basically the evolution of mixed use. It's about creating a totally self-contained ecosystem. The best example from this week's news is down in Houston with the Toro District.
That's the project involving the Houston Texans, right?
Yeah. Howard Hughes and the Houston Texans revealed an 83-acre plan. It's centered around the sports team's headquarters, obviously, but it includes 300,000 square feet of retail, plus office and hotel space.
Wow.
It's designed so that the resident or the worker never really has to leave the district for their daily needs or entertainment.
We're seeing something really similar in West Houston, too, with the silo site.
Oh, right.
Yeah, they're taking these historic grain silos and turning them into a mixed-use destination. It really feels like for a retail broker, the game is changing from simply leasing space to actually curating a vibe or a full destination.
I think that's a very accurate assessment. The commodity retail is aggregating in those grocery-anchored strips we discussed earlier.
Mhm.
But the lifestyle retail, the dining, the entertainment, the social spaces is all moving to these mixed-use districts.
And if you're stuck in the middle,
Like an old enclosed mall with no grocery anchor and no distinct atmosphere,
Yeah.
then you are in the Palisades Center situation.
heading to foreclosure. Okay, so the fundamentals in Texas are clearly strong.
Yeah.
But we don't operate in a vacuum. We have to talk about the macro curveballs.
And this week delivered a massive one.
It did. From the Supreme Court regarding tariffs, again, we're strictly looking at this from a real estate mechanics perspective, not taking political sides here.
Strictly business. And it was a legal roller coaster with direct implications for construction pricing. So on February 20th, the Supreme Court ruled 6-3 to strike down the president's tariffs that were based on IEPA.
Which is the International Emergency Economic Powers Act.
Right.
And initially, the market reaction was relief, right? The assumption was that tariffs were gone and therefore material costs would finally go down.
That relief lasted about 5 minutes.
Yeah.
The administration immediately pivoted. They used a totally different law, Section 122 of the Trade Act of 1974, to impose a new global tariff.
And where did that land?
It started at 10% with a stated target of 15%.
Okay, so for a developer who's trying to price out steel or lumber for that new project in Arlington or Plano, what does this legal back and forth actually mean?
It means pure volatility. And markets hate uncertainty even more than they hate high prices.
That's a great point.
Right, like if you know steel is expensive, you can underwrite it into your rents. You make the math work. But if you don't know if a tariff is going to be 0% or 15% next month because of a court battle or a new executive order.
You hesitate.
Exactly. It makes underwriting new developments so much trickier and forces general contractors to build in much larger contingencies.
So construction costs remain a moving target. What about the financing side? Because we keep hearing about distress, but as we noted, Blackstone just got a huge $331 million loan.
That is the paradox of the current capital markets. They are bifurcated, just like the retail space. The bad news is highly concentrated in office.
Right.
Office loan delinquencies hit an all-time record of 12.34% in January.
12.34. That is higher than the peak of the financial crisis, isn't it?
It is, but, and this is the key takeaway for our listeners, there is massive liquidity out there for the right assets.
Give me some good news on that front.
Mortgage rates dropped below 6% for the first time since 2022.
Oh, that's huge. That's a massive psychological threshold for borrowers.
Totally. And a recent survey showed that 72% of Texas owners plan to be net buyers in 2026.
72%. So the money is definitely there. It's just highly selective.
Exactly. Blackstone getting a loan for grocery-anchored Texas retail, that gets done all day. Someone trying to refinance a Class B office tower in downtown Chicago, that is effectively impossible right now.
Speaking of office and tech, we have to touch on AI before we wrap up. It's been the dominant theme for 2 years, but we actually saw some counterintuitive movement this week in the markets.
We did. Now, on the physical side, AI is absolutely still driving real estate demand. Microsoft is planning a $400 million data center in Castroville. Google is expanding in Midlothian. That demand for square footage and power is very real.
However, I read that data center construction actually fell recently.
It did. Bloomberg reported that U.S. data center construction dropped, but not because demand is down.
Why then?
Because of power and permitting delays, they literally cannot get the electricity hookups fast enough. It's a pure supply-side constraint.
Wow. And then you had the stock market reaction regarding the service firms.
That was the big surprise of the week. Stocks for major firms like CoStar and CBRE took a significant hit.
Even though those companies reported really strong earnings, right?
Yes. CoStar and CBRE posted great numbers, but investors got spooked that AI might disrupt their business models, basically fearing that AI will replace the need for brokers or researchers in the future.
So the AI fear trade wiped out billions in market value.
Exactly. It shows just how jittery the broader market is about technology disruption, even when the physical real estate fundamentals like leasing activity are holding up really well.
It's wild. So let's try to pull this all together for the listener. If you are a broker at Eureka Business Group in DFW, and you're looking at your deal pipeline today, what is the synthesis?
The synthesis is selective aggression. The capital is abundant, but it's discerning.
Right.
If you are bringing a grocery-anchored deal or a strip center in a high-growth corridor like McKinney or Plano, you are in the golden age. There's debt available, there's equity available, and occupancy is at record highs.
But the advice is to stay far away from that middle ground.
Correct. Avoid the commodity product that isn't essential, and keep a very close eye on the macro volatility regarding construction costs. The tariff war isn't over, it's just changed legal venues, so leave yourself some contingency room in those development budgets.
And the data suggests we should just never bet against Texas job growth.
That is your underlying safety net. As long as Apple is making Mac Minis in Houston and AT&T is putting 4,000 people in Plano, the retail demand will be there. Texas is just operating on a different gear than the rest of the country.
It really is. You know, we talked about districts earlier. I want to leave our listeners with a final thought on that.
Let's hear it.
We are seeing retail completely redefined. It used to be about shopping centers. You go, you buy, you leave. Now, with projects like the Toro District and the Silo site, and even what Trademark is doing in Arlington, are we seeing the end of the shopping center and the birth of the social hub?
That is the deeper shift. In a world where you can buy almost anything on Amazon, and Amazon is actually buying land for huge new store concepts near Chicago right now. By the way, physical retail has to offer something digital cannot.
Human connection.
Exactly.
And specifically for DFW, I'm thinking about that AT&T move. When you drop a corporate campus of that magnitude into Plano, how does that reshape the retail map for the next 10 years?
It completely changes the center of gravity.
Does it pull gravity away from other hubs?
Yeah.
It is definitely something to watch.
It's going to be a fascinating year.
Well, that's a wrap for this week's Deep Dive. This Deep Dive was brought to you by Eureka Business Group, your authority for commercial real estate in Dallas-Fort Worth.
Thanks for listening.
We will catch you next week.